All right, good morning. This webinar is about risk and size management for the swing trader. For those of you who are not familiar with swing trading, it's typically that sweet spot outside of the realm of day trading and investing for the short term, where you plan on holding a position for anywhere between a couple of days to a couple of weeks. And there's numerous strategies and tactics for achieving that swing trading goal. But what I want to do in this webinar is I want to briefly touch on how risk and size management is really a significant part of achieving consistent success in this type of trading style. Slide here. So why is risk management important? So risk management is basically balancing risk and reward, and which is a key component to any trading style. And if you always want to tip the odds into your favor when it comes to trading. And, it was once said by the baseball great Ted Williams that baseball is the only endeavor where a man can succeed 3 times out of 10 and still be considered a really good performer. And as much as I would agree with that quote, I would also say that trading is probably the other realm that actually offers the same exact odds if you know how to, just tip with a little math, just tip the odds in your favor. And if we look at this first screen over here, we can see that if you have a win-loss rate of 30 to 70, that's 30% wins to 70% losers, and you're betting the same consistent amount, say $100. 3 winners will obviously give you $300. 7 losses will give you a loss of $700 for a combined total of $400 in losses. Right? So obviously that's not those are not putting the odds in your favor at all. The odds are actually against you. If we take those same exact odds at 37 win-loss rate and we just adjust the numbers slightly to say, we're going to take $200 wins, but we're going to cut our losses really short, say half of what we initially intended, to $50. You'll see that 7 losses actually add up to $350, whereas 3 wins will add up to $600 for a net gain of $250. So this is the critical part you have to understand about risk management and putting odds in your favor, and why position sizing and why cutting your losses and letting your winners run is so crucial to long-term success. Is that even with a losing system that only wins 30% of the time, you can still come out ahead as long as you let your winners run and cut your losses short. So when it comes to actually position sizing, typically the classic way of doing it is just to see how much capital you can risk, and you divide that amount of capital by the actual share price itself. And I show 2 examples here. One is in Facebook, and you can see it's an $81.50 stock at the time of this recording. And if you were to just take, say, $50,000 and divide that by the price of $81.50 itself, it would tell you you should be buying around 600 shares of stock. And that's all fine, but the problem is that you're not taking into the actual behavior or the volatility of the stock itself. And by ignoring the volatility, you're essentially could be taking on too much risk than necessary. And to prove this point, I want to show that another example right below. I use Procter & Gamble, which is around an $82 and $25 stock. So give or take, these are both around $82. They both have about same amount of shares in the float. I think it's around 1 billion shares in the float. And Facebook actually does about 3 times as much daily volume as Procter & Gamble. So they're both about in the same proximity. However, if you had a $50,000 account, you would be buying that same exact 600 shares. But by ignoring volatility, Facebook actually moves almost over 2% a day. It has an ATR of $1.75. That's an average true range over the course of about 2 weeks. Whereas Procter & Gamble has an average true range of about $1, and it trades on an average of about $1.3% a day. You're ignoring that by ignoring that volatility, you can actually be taking on more risk than necessary. And the proper way to do it, or at least the way that I do it, is to take your $50,000 divided by the ATR times the price. So for something like Facebook, I should only be trading around 350 shares, whereas since the volatility is lower on Procter and Gamble, for a $50,000 account, I'll take that 50,000 divided by ATR times price, and it would tell me that I should be trading around 568 shares, which is, compared 350 to 568, you're looking at almost double that amount. But again, that's because it's taking volatility into account. And this is where a lot of traders, they see a price of $81, they look at their capital, um, they don't look at the actual range of the stock and how it is trading. And by ignoring that one component, you're probably going to get stopped out maybe a little bit more, or your stops are too tight, or you're just taking on too big size. So it's really a critical part to factor into when to figure out your share size. If you didn't get that, here's just another example table, and you can go back and look at this later. So here's an example of Twitter, which is a $50 stock with an ATR of $1.75. You have Apple, which is a $125 stock with a daily ATR of 225, and you have GE, which is a $25 stock, which is a daily ATR of 30 cents. Um, another way to do it, if you're really risk averse and you don't want to use the daily ATR, you could use the weekly ATR. Obviously, that's going to give you a smaller share amount, which is great for swing trading, because you have to understand when you're swing trading, um, you're basically trying to capture a move over a few days or maybe a few weeks. So you should always be aware of what the average weekly range is on these stocks over the last few weeks. See, Twitter's been moving on average around 3.25. Apple's been moving about 5.5. GE's been moving less than $1. For when it comes to position sizing, I've also seen certain people take the average of the daily and the weekly, and that's what they did on this entire graph here. I took the average between the daily and the weekly, got 2.5 for Twitter, and then I just kind of went through and said, all right, for a capital of 10,000 shares, if you have capital at a risk of 10,000 and you have a certain risk percentage, how many shares should you do based upon that risk percentage? And it would tell you should be only trading 40 shares, and this would tell you what the percentage of capital is. Here you see 50,000. If you have 50,000 in capital, and you say you're willing to risk 2% on each trade, which is $1,000, you can take the risk or the reward of 1,000 divided by the average ATR of 2.5 and get 400, which would be about 40% of your capital. Now notice that obviously the bigger risk you're taking and the larger size you're taking, you're also risking a larger percentage of your capital. And risking 40% of 50,000, 40% of your capital when you only have 50,000, just some people that's a little bit too high risk. You should probably be more focused on the 10 to 20% of your total capital. And over here at the end, you can see if you have 100,000 shares or more, what you should be risking on each one based upon their weekly, their average ATR. The last part I want to just wrap up this webinar with is, do you actually have any realistic goals? And this is a problem that I've noticed with a lot of traders. Um, Nobody really, they seem to just trade and let go with the flow, and they don't actually have an end goal for the week or an end goal for the month or an end goal for the year, even for daily for that matter. And when you're swing trading, you should always, or trading in general, you should always have some sort of goal to attain. And you have to be realistic. Obviously, if you have a $10,000 account and you're trying to get up to 30,000, that's going to be a 200% return. I'm not saying that's not doable, but to do that, you have to understand the math. So to take your account from 10,000 to 30,000, it's a $20,000 gain. And on this table below, if you look over here, 20,000 falls right in this realm here under 24. You are basically averaging under $2,000 a month, under $500 a week, and under $100 a day. Now, if you break it all down into that smaller size, achieving trading to the point where you can make $100 a day is extremely doable. But you need that consistency and that discipline and that key risk management and that key position sizing to have the discipline to go in and out and just attain that goal of $100 a day or $500 a week or $2,000 a month in order to make that $20,000 a year. All too often I see people sitting there trying to get rich quick, and they're going to take their full 10,000 and put it all into one stock and not focus on position sizing or taking in the volatility of a stock, and they're going to wind up blowing up the account much faster, and they're not going to attain that goal that they wanted to achieve. Something more realistic might be to take a $100,000 account, say up 20% to 120,000. Again, it's a $20,000 gain. You only need to make $100 a day on that, which is extremely doable. And you can risk a lot more, and you can do proper position sizing, and you can get focus on the volatility. Just way more achievable. Um, Again, look at this table, figure out where you stand, set a goal for yourself, and then look down here and see how much do you actually need to be making on a daily basis or a weekly basis to attain your long-term goal. And this is not something you should just look at once and never look at it again for the whole year. You should basically print this out or make a note for yourself of what your goal is each day. And if you ever find yourself, um, taking on too much risk and going above and beyond what you need to achieve for each week or month, you really need to take in the reins a little bit more, because otherwise you're going to be just gambling and over risking everything, and you don't want to do that. This middle part here, obviously, is if you have a $10,000 account and you're risking 1%, it's $100. If you have a $50,000 account and you're risking 5%, that's $2,500 on each one. And again, you need to take that into account as how much you should be risking on a daily basis, on a weekly basis, to achieve your longer-term goals. So in summary, I just want to go through a few key points. Is that you need to definitely first identify your goal. Look at your capital that you have, know how much you can risk on each trade, find out a goal. What are you trying to achieve based upon that table that we just showed? And know how much you know the minimum amount that you need to achieve that goal. You should be knowing how much you need to make each day, each week, each month. And when you achieve that goal, do the best you can to protect that going forward. You should be understanding the appropriate risk within the capital that you have, and the risk that you should be taking on to achieve that goal. You don't want to ever take on way too much risk than necessary. Uh, the other key component to successful trading is just to stay consistent and disciplined with your plan. Once you've identified your goal, and once you've identified the risk reward that you need to take on each trade, you have to stay consistent. Stay consistent and disciplined day in and day out with your trading. When it comes to actual position sizing and share sizing, I personally like to incorporate volatility for the reasons that I showed. Is that an $82 stock can be a lot different. Doesn't mean you should be trading 600 shares with a $50,000 account, because the volatility can be double that on certain stocks depending on their momentum and how hot they are. And you need to uh, you can scale back, so to speak, just to take on less risk and still get the same type of movement necessary to achieve your goals. And lastly, I didn't really touch on this too much, but if you're really trying to reduce your risk on trading, a lot of people usually think trading has to be an all-in and all-out methodology. They have to go in with a full size and come out with a full size. And the reality is you don't have to do that. You can easily scale in, say, on thirds around a particular share price. You can scale in on quarters. You can scale in on just halves. And it's the same when you take profits. You can easily just scale out half of a position or scale out a third of a position and tighten up your stops around that vicinity. You know, scaling in and scaling out is an excellent way to reduce your risk, and not take on too much all at once. And it's just something that you might want to consider while you're trying to achieve these longer term goals. So that wraps up this quick webinar on risk and size management for swing trading. If you have any further questions, you can contact our sales department at briefing.com. And that's the end. Thank you.